Okay, guys, so I thought I'd just do a quick ECB preview ahead of the rate announcement at 12:45. So that's, we still got time here, an hour and a half. And then the Draghi press conference, of course, that will begin at 1:30. So there's two parts to this event, although I have to say, really, today there's only one, because at 12:45, the ECB will announce their interest rates, and I would say it's like 99.999999% likely they will leave all their interest rates unchanged. Okay, they're not going to change rates. They changed rates last time. So remember, the last meeting was back on the 5th. No, it wasn't. On the 3rd of December, and I'll talk about that in a minute. That was a very dramatic day. What's likely to happen is that today will not be a dramatic day. Okay, I think that most of the markets aren't, well, firstly, they're distracted and they've got their eyes elsewhere. All right, it's China and it's oil. So this ECB meeting comes at a point where focus is not on Eurozone monetary policy. And we're not expecting anything at today's meeting. That's the point. And so, most likely it's going to be a fairly uneventful one. All right. So you've got to bear that in mind. Let's just let's do two things. Quick look back at the last meeting 6 weeks ago. Let's do that first. Then we'll look at just what's happening in markets in the run up to today and just talk a bit about some of the potential things that Draghi might be talking about and what we need to be focusing on. Okay. But you don't need me to point towards where the last meeting was on this Eurodollar chart. It was one of the most remarkable days for this market ever in its history. The 3rd of December, this monumental blue, well in my case, blue candle as the Eurodollar market had a 500 pip range. And this was where, and the irony was that the Eurodollar had one of its biggest ever rallies on the day that the ECB cut rates, when of course in theory a rate cut, certainly in the short term, should lead to the currency's value going down, except not only did it not go down, it had its biggest move to the upside ever. And of course this is because even though the ECB cut rates, they did not deliver the package of goodies that we wanted. Markets were positioned for an expansion and an extension to the QE program, and that's what we didn't get. All right. What happened was, as you will probably remember, Draghi cut the deposit rate by the smallest possible amount, by 0.1%. So they dropped the deposit rate from -0.2% down to -0.3%. Then with the QE program, they extended it, but by only 6 months. So instead of the 60 billion euros a month program ending in September 2016, they extended it to end in March 2017. So they added 6 more months to the program. Markets were looking for a larger extension. Some people wanted a 12-month extension. Then the other, and probably the most important point, markets wanted an expansion, an increase to the monthly purchases. They wanted to see, instead of 60 billion a month, they wanted to see more like 70 billion. And that's what Draghi did not deliver. So it was really the QE program, the under-delivery on the QE program that led to the huge burst higher on Eurodollar. A lot of this pricing in, the drop between mid-October down to the 3rd of December was all about pricing in a big step up and a big extension of the ECB stimulus program. Plus it was pricing in a US rate hike, of course. But you can see on this chart, I've got a daily chart here looking back at the last 4 months, and the two biggest candles, so the December the 3rd rally and the October the 22nd sell-off, the two biggest rallies in this picture are the last 2 ECB days. So the point is the ECB and Mario Draghi has the most power to move this market. Having said that, probably today Draghi's not going to move this market. We'll talk about that in a second. Right, let's just look at how markets have been behaving. Well, obviously yesterday was a remarkable session. So the reason why focus is elsewhere is because we've had dramatic events this year. Look, this is a weekly chart of the S&P, and this has been spoken about already earlier in the session, but clearly a massive move lower yesterday, flirting with the 1800 handle, testing the October 2014 low. We broke it, and in fact, let me add a second line on this weekly chart, which I don't have on here, which is the April 2014 low, and that's basically where we bottomed out. So that was 1803.25, and yesterday's low was 1804.25. So we were 4 ticks off, testing the April 2014 low. So, clearly a big move. The other notable point about this is, of course, the fact that in percentage terms, if I measure from the top, the all-time high in May of 2015, down to yesterday's low, we're at 15% now. A lot of these markets, these global indexes, are in bear market territory. That means they've dropped 20% off recent highs. The S&P is yet to join that camp, but the FTSE touched down on minus 20% off 2015 highs yesterday. We've already got markets like the Nikkei 225, the DAX, the Shanghai Comp, obviously. All these are in bear market territory. The S&P not yet. And actually, just whilst I'm on that, here's where the S&P needs to get to be in a bear market. It needs to sell off to 1700, not 1800. We need another 100 points to get into bear market territory, which is what some of these global indexes are in. If that were to happen, obviously it's a big if, but if we did get down there, that would be, I'm just trying to figure this out, that would be a 2.5-year low back to October 2013. So look, we're in a very negative sentiment environment, but I will say the rebound yesterday, if we just go to a 1-hour chart, was just sensational. So quite really unbelievable rebound, like a 70-point rebound into the close. We added to it briefly at the start of the Asian session, then it all came crashing back down as the index sold off 40 points, and now we're kind of trying to stabilize, and it's just like, well, where do we go next? Certainly we're in a downward trend. Even though we had a phenomenal bounce yesterday, we're still in a negative sentiment environment. Oil is on its low and is not far off yesterday's low, so we're only 50 cents off yesterday's low on crude. So, certainly you've got to carry on thinking downtrend here, unless something dramatic happens, like Mario Draghi delivers a very dovish statement, which is unlikely. So, look, attention is not on the ECB really at the moment. That's why we're probably not expecting too much out of today's session. So let's talk about what might happen today. So 12:45, they're going to say that interest rates stay unchanged. So the deposit rate remains at minus 0.3%. The refi rate remains at plus 0.05%. The lending rate remains at plus 0.3%. All right, they're going to leave those unchanged. So 12:45 should not be a market moving event. We then move to 1:30. And of course, Draghi has his press conference. So what is Draghi going to say, and how are markets likely going to react to it? Now, it's a tricky one here for Draghi. Does he fall into the short-term panic trap, whereby he's going to deliver a message that is influenced by the acute market turmoil of the last couple of weeks? Is he going to fall into this trap and try and reassure markets by being dovish, by, alluding to the fact that the ECB can do more, and maybe he'll go further and the ECB will do more? Is he going to fall into this trap? I think not. I think that ultimately these central bankers have to look through the market short-term chaos and concentrate their efforts more on the fundamentals. And this is the tricky thing, because the fundamentals for the Eurozone are pretty strong. In fact, they're definitely stronger than most we've had a good 2015 for Eurozone growth. It looks like, if anything, it picked up in momentum into the end of 2015. You've got, things like the manufacturing and services PMIs for the Eurozone are very strong and trending higher. So, we had Draghi not delivering more stimulus at the start of December, and that's because there's a real reluctance from the German camp to allow the ECB to do more. And are they justified in needing any more when the economic fundamentals are solid? Of course, what the ECB need to decide is, are the international risks, have they increased significantly enough for this to undermine Eurozone growth momentum? If so, well then fine. That's justification for them doing more. But I think it's too early for that. From a central banker's point of view, I think it's too early, just after a couple of weeks of market panic, it's too early to say international risks from China, particularly, are going to undermine Eurozone growth in 2016, so we need to do more. I think it's too early to make that call. So I think what Draghi is going to do today is he will remain fairly upbeat. He will want to deliver a positive message about the Eurozone's economy and economic outlook. He will want to be positive about the effects of their stimulus program. Don't forget, they're still printing 60 billion euros a month. This is the 10th month of that now. January is the 10th month. So it's not like they're not doing anything. It's 60 billion a month. He'll want to be positive and say that this is having an effect and that the economic conditions are improving. Okay. So that's a positive message. That might be interpreted as a hawkish message, because if he's bullish and positive on the economy, then they don't need to do more. They don't need to extend their QE program. And you know what? You could go further than that and say, well, if they're right, if the economy does pick up momentum through 2016, well, maybe in 6 months' time, rather than talking about more, maybe we're going to start talking about less. What about an ECB tapering by the end of 2016? What about that? That might happen. So I think at the moment, Draghi's got to be neutral, but he's going to be positive on the economy, which could be interpreted as hawkish, but he'll most likely offset that hawkishness by talking about the inflation environment, which is obviously still looking very negative. And here, let me bring in the price of oil, because oil's still plummeting. There is no end to this, it seems. And of course, the lower oil goes, and generally the lower commodities go, because this is not just an oil story, it is a commodity story as well. So the lower these commodities go, the worse it is for inflation in 2016. If you're looking at January inflation, just looking at the oil element, well, we're trading at $28. Well, where were we trading in January 2015? Let me scroll back. So looking on an annualized basis, look, maybe like a rough average. Now you're looking at about $50 as an average. So $50 down to 28. That's whatever it is, 40 to 45% drop. So that's still very, very, very negative for the inflation basket. So what's most likely going to happen is they're going to have to revise down their inflation forecasts. The one important thing about this meeting will be the ECB's inflation forecasts and how they change. He'll announce this in his statement that he reads out at the beginning of the press conference. Are they going to lower their inflation forecast? If so, that's dovish. And there's more chance they'll extend QE or do more, or maybe cut the deposit rate further. Okay? So I think this is going to be a tricky one to trade, because I think you're going to get a conflicting message. I think the economic outlook will be positive. They might even upgrade GDP forecasts. That'll be hawkish, but that'll be offset by the inflation outlook, which is most likely going to remain negative and get revised down, which will be dovish. So I think from a trading point of view, this could be quite neutral in the end, but it doesn't mean we're not going to get some choppiness and short-term reaction as comments are made one way and the other. I think the euro dollar is an interesting one because look at this market. Look where it's gone over the last 6 weeks. Since the last press conference, I'll tell you where it's gone. It's gone nowhere. We had a phenomenal spike, and then we've had a very messy consolidation ever since. And we're right in the middle of this kind of range. This is a big range, 111 on the upside down to 107 roughly on the downside. We're kind of in the middle of it. So, you know, there is scope for this market to move. I'd say 110. Let me add another level in here. Certainly 110 is important. That's been the barrier on the upside for 2016. We flirted with it on the 11th of January. We tested it on the 15th. We flirted with it yesterday. But ultimately, the 110 handle every time has been a resistance point that's triggered a reversal back lower. So 110 is key. If we get up towards 110, it will be resistance as long as Draghi delivers a neutral, overall neutral message. How is this market going to go above 110 and maybe test 111? Well, the hawkish element is going to have to be missing. So he's going to have to be dovish about inflation, and then he's going to have to be less confident about the economic conditions. He's going to have to paint a picture where he's going to portray the idea the ECB are really worried about China. They're really worried about the ongoing market turmoil, and that they think this is going to have a negative effect on the Eurozone economy. So if he's dovish, oh, sorry, I'm putting this the wrong way around, aren't I? Sorry, if he's dovish, the euro is going to move lower. Apologies. If he does do that, so if he does deliver a dovish statement, you're going to get down to possibly 107, right? The year's low is on the 5th of January, 107.29. So if he's pessimistic about the economy and he's dovish on inflation, euro down to 107, okay? If he's the opposite, if he's only hawkish, so let's say he remains positive about the economy. Let's say he's not bothered at this point about international risks. If he says the market turmoil, you know, it's just short term, they're not too concerned about it. If they revise up GDP growth, and if they do not lower inflation forecasts, that's that dovish element on inflation. If that's missing, well, sure, we get a hawkish move up through 110, okay? So that's basically it. You're most likely going to get a hawkish message on the economy and a dovish message on inflation, and they're going to offset each other, and perhaps these markets aren't going to move too far away from where they are now. For a big move, you're going to need either the hawkish message to not be there, or you're going to need the dovish message to not be there, okay? With the Bund, I think the Bund's interesting because you've had such safe haven flow, and on price, we're all-time highs here. On price, not on yield. On price, we've never been higher. Look at the 2015 high back in April 2015, 160.69. That got taken out yesterday. The Bund is trading an all-time high price, okay? It goes back to the daily time frame. So that level's here, 160.69. That's on a continuation chart. I'm going to add another line, which is last week's high, the 15th of January high, which is at 160.52. So here are some support levels on the way down, with on the way up. Well, it's hard to find resistance levels when this thing's never traded here. Of course, you've got yesterday's high, which is today's high, 161.34. And then you got your pivot levels here. But, you know, of course, for the Bund to move higher, you're going to need dovishness. So you're going to need that, well, yeah, you're going to need that inflation downgrade. You're going to need lots of talk about the concern that inflation's still heading lower. You know, any negative inflationary message should help the Bund to push higher as we price in more QE. And of course, you know, yields drop because inflation expectations drop. Okay, so both will be positive for price. But then if Draghi delivers a positive message on the economy, though, and he downplays the concern about China and so on, well, maybe there's been too much safe haven flow here, and that could get reversed. So, you know, again, it's going to be tricky because the message is most likely going to be neutral, hawkish and dovish. But certainly the Bund's up here on all-time ever high price-wise. With regards to oil, I mean, oil's not going to be directly affected by this press conference. I think for once, as long as oil's stable as we go into Draghi, it's stable at the moment. We've been consolidating. As long as that remains the case, forget about oil this afternoon. But if we're like halfway through the press conference and oil, for its own reasons, breaks yesterday's low, well then actually forget about the press conference, because as I said at the start of this briefing, the ECB is not the focus here. It's China and it's commodities. So oil could easily take over as being the driver of market behavior mid-ECB press conference. So you've got to keep your eye on oil, but as long as it's stable and around about $28, sure, you need to focus on Draghi and he'll dictate price action. Okay, so that's it. We're not expecting a big one here. We're not expecting a December the 3rd, and we'll most likely see no rate hike, or, well, certainly no rate hike. I should say we'll most likely see no rate cut. That's going to be announced at 12:45 and the press conference at 1:30. Okay, all the best.